This is Mike Zlotnik, Big Mike. I'm here with Matt Ricciardella. Hey, Matt.
How you doing, Mike? Thanks
Great.
for coming to our office today.
Thank you so much for inviting me to come with Crystal View Capital. They are one of the best mobile home community operators in the country. So appreciate you all tuning in. Let's talk a little bit about you. Just a couple of words about you first. You come from upstate New York.
I do, yeah. I know we were just chatting. You spent some time in Rochester. I'm from the Catskills, about 90 minutes outside of Manhattan. And I grew up in the restaurant business, actually. My father had a few restaurants in a small town and started as a kid, 9 years old, working in the kitchen, so learning the value of a dollar at a very young age. Moved out when I was 20 years old, went to Southern California, became a realtor at first. I was doing direct phone calls and prospecting to build up my business and kind of fell into home flips at the time. I started flipping homes after that. And one thing led to the next, kind of gravitated into manufactured housing and self-storage. Liked the idea that it was an inefficient market. It was very fragmented. Mom and pop owned and operated. I could use my sales skills to buy the deals, buy them right, and then influence the value by directly affecting revenue, expenses, driving NOI, and building great value for myself. And did really, really well and had a limited amount of capital, wanted to scale, and started raising outside capital back in 2014, and that was the birth of Crystal View Capital, and here we are today.
So you've been doing it at this point, 12 years?
Yeah, as in the fund structure. I've been investing personally in the asset for 20.
Oh, that's wonderful.
Yeah.
And tell folks a little bit about manufactured housing communities. Now that's the term. The good old war term used to be called mobile home park. What's the difference between manufactured housing communities and mobile home parks?
Naming convention. Back in the day, they were called trailer parks, trailer courts, mobile home parks, mobile
There's
home communities.
Stigma, a little bit of that.
Well, there's definitely a negative stigma or connotation from the past where, it was thought that these were the worst of the worst living in these communities. They could barely afford the rent. There was drug deals going on. And I could tell you it's the furthest thing from the truth. Mike, in our communities, we have paved streets, clubhouses, health centers. These communities are gorgeous. These people have great pride of ownership because they own their home. That's the nuance here. When you compare what we do to multifamily as an example, where they rent and they'll just move on and rent down the street, here they stay. And they stay indefinitely because this is their largest asset. They own their home. We rent them the dirt. And they have great pride of ownership. And these tenants are very sticky. We build relationships with them for the long term. We're a long-term operator. And we built tremendous value for our residents, our investors, and our firm. And it's been a fantastic ride.
It's great to hear. So from what I understand, it's the most affordable ownership of property you could have. If you buy...
It really is.
A normally built home, it's going to be twice as much as manufactured, maybe even more.
I would argue to say 4 or 5, 6x. Depending on the market. Like here in Vegas, I would say the average price of a home is probably $500,000-$600,000.
And a manufactured home here would cost
80, 100.
That's crazy.
Yeah.
Affordability is insane.
It's insane. Yeah, it absolutely is.
Do you do a lot of business here in Vegas? And how did you wind up in Vegas? Or do you do more of a Midwest where there are a lot of mobile home parks?
We have some assets here, but it's interesting. We're mostly Midwest focused. The states, like our largest state is Wisconsin. So we've got a large presence in Wisconsin, Michigan, Indiana, Ohio, Minnesota, those type of states. We are kind of spread out. We have stuff in Texas. We have stuff in Washington State. We're really agnostic. We like the Midwest because of the yield that it presents for our investors. But to answer your question, the reason I ended up here in Vegas is years ago, I bought a string of gas stations, actually, from a bank during the GFC, turned them around, sold them, but my wife and I liked it here. We raised a family and built the company here and decided to stay, and it's been a great city for us.
Yeah, very interesting.
Yeah.
So let's go back to the manufactured housing communities.
Sure.
How do you typically execute a value add plan? Take us through a basic life cycle of acquisition.
Yeah.
What kind of value add do you do?
Yep.
And do you take these projects to a fast refi. Just curious how the whole process works.
Yeah, each deal is a little different, but I'm going to give you a general overview of what we like in the deals that we do. First off, we like the larger deals. So when I say larger, preferably 200 sites plus. We like assets with a little bit of vacancy because we have an in-house home sales organization where we could bring in new product, fill vacant sites, grow occupancy, which a lot of operators can't do because it's a lot of work, and we have relationships with all the dealers. So we're looking for communities of a certain size, some vacancy in them.
How many dollars? So give me an example. If
Yeah.
you're buying 200, 250 pad community, what are you paying for that?
We've got, I'll give you some context here. We've got 2 parks under contract in the general Midwest area, and we've got them, they're about 350 to 400 sites each.
What's bigger parks?
They're bigger parks. They're institutional quality. And we have them under contract for high 70s, low 80s per site. So 30, 35 million on those parks, just to give you some flavor of the price points. Now, when you go down on the quality
So
spectrum,
per pad, you're paying, how much are you paying per pad here? You're
about
paying
80,000.
80,000 a pad.
Yeah.
And what's the rent on a pad per month?
So on these particular communities, the rent is about 400 a month, give or take.
That's so low.
It's so low. And the market, give or take, is 700.
Oh,
A lot
you're
of
buying
these-
them at a way below. I guess the operators were mom and pop, they were not keeping rents.
Yes. That's
Are the
right.
tenants able to afford going from 400 to 700?
Well, to answer your question, they are, but we do that responsibly. So rather than, yes, the market is there, but I think that there's going to be some sticker shock if you push that hard, that fast. So we have a more measured and graduated increase schedule that we follow. And I give you an example on some of the communities that we own where we're half the market, we'll probably go from 400 to 550 year one. We'll go from, 550 to 650 year two. So it will take us, let's call it 3 to 5 years to catch up to the market. And frankly, by the time we do, the market's now at 800, 900, 1,000.
So you're still more affordable than competing products.
We're still the cheapest in the market, usually, is how we structure it. And we invest back into the communities, Mike. It's not
What
just...
kind of investments? What do you do to improve the community?
So it depends on the community. I'll give you an example. In our Fund 3, we bought a 413 site community in Iowa, and we bought it really good. I mean, we paid $10 million for it. The roads in this entire community were shot. I mean, there was huge potholes. That was in complete disarray. We repaved all of the roads. That cost us $1 million. So just to give you a feel, like the residents were extremely happy, and that makes their home more valuable as well. When they go to sell their home or they go to refi their home, the quality of the community drives the valuation for their home. So when they see us invest back into the community, it's a partnership because it helps them at the end of the day.
So it's an easy, they see improvements.
Yes.
And you have a good story.
Yes, 100%.
You're doing the increases responsibly, showing the value first.
That's right.
Reciprocity.
That's right.
You're helping them with better quality of life, and then they
in turn help us because you know what? When we bring these homes into these vacant sites, they're the first ones to tell friends and family, hey, I've got a great place for you. I live in this community. These people are responsible. They're investing back into the community. And that's how we sell 90% of our homes is word of mouth from our existing residents. So that there tells you that we behave properly and we treat this as a partnership. Some of these operators we were just discussing don't. They're very egregious. They're not present. They don't do the third party. For management, they outsource to a third party.
And you have in-house.
We're all in-house. We're all vertically integrated.
So every person is a W-2 employee of the firm managing.
That's right. That's right. We have 200 employees in this company.
That's wonderful. People feel connection. They feel that's part of their life and their purpose.
That's right.
So
That's right.
So how fast are you able to refi typically these projects once you acquire them?
Yeah, each deal is different depending on the value add. My preference is to refi within 12 to 18 months of ownership. And usually you're going to refinance with the agencies. So it's going to be Fannie or Freddie. So if you go in and you execute an increase, or you're passing through expenses, which is another lever we pull to create value. Let's say we're passing through utilities, we're bringing in homes, we're increasing occupancy. We'll go back to one of the agencies once it's stabilized. The idea is we'd like to pull out all of our equity, if not the majority. Let's call it 70 to 100% of our equity in that refinance. And then we just kind of sit back and create value year over year over, let's call it a 5 to 10 year holding pattern.
It makes a lot of sense from investor's perspective. You could cycle my money back, most of it, within 18 months. I'm happy to be your partner for many years to come.
That's right.
So let's talk a little bit about tax benefits. So, Lauren, this is what attracted me to the manufactured housing communities. The cost segregation benefits are far better than any other asset class that I know. Far better than industrial, far better than retail, far better than even the multifamily. Mm-hmm. So let's talk a little bit about that. How is it possible that the cost segregation, the bonus depreciation, gets first year what? Usually 60 cents on a dollar, 70 cents on a dollar. So if something is bought for $10 million, first year cost seg is what, 6 to 7 million approximately? That's,
generally speaking, sometimes more, sometimes less.
How is it possible physically? I'm just trying to understand.
Yeah.
How do they cost seg? Because you don't own those homes. I guess you land, the roads. I guess you cost seg all the improvements.
So full disclosure, I'm not an engineer, but I could tell you just by being an investor, and I don't own those other asset classes, but I could tell you what I believe the core reason and rationale behind it is. So when you're doing a cost seg, the first thing that you're going to do is you're going to parse out the land, the dirt.
Which is usually 20% of the value is just the dirt, typically in multifamily.
It depends. So if you're in so you have to do comps. You have to substantiate that with comps. Where we own, these are a lot of secondary, tertiary, rural markets. So you could support comps that are a lot lower on the land side. If you're buying an office building in Midtown Manhattan, there's inherent value to that
massive
dirt.
Value of the land.
So it's hard to parse out a smaller component of the overall purchase price to the dirt in Midtown Manhattan than if you're in rural Michigan, as an example.
Makes sense.
So let's just start there. When you do that, you're way ahead of the game. Now, you've got roads, improvements, clubhouses, street lights, even trees. You start to depreciate and accelerate that depreciation. That's the reason why you're ahead of most other asset classes. That's part of the reason why we love this asset class, along with the fundamentals behind supply and demand. And the overwhelming demand as we see it in the market right now for affordable housing is just off the charts.
Appreciate the explanation on the cost segregation. It's actually, I'm just, again, being a mathematician by education, I'm curious how it works, but it's a conversation with an engineer, and what you explain makes a lot of sense. So let's talk a little bit about affordability. How does this compare to traditional ownership? Like you said, it's way less expensive, but you have to pay the pad rent, right?
That's right.
And then any other expenses the tenant has to pay. Utilities, is that usually part of they pay for their own utilities?
Occasionally. In most of our parks, the tenant pays their own utilities. Occasionally it's included. So they're going to be paying their water, their sewer, their trash, their electric, and their repair and maintenance. So as opposed to multifamily, when the landlord is responsible, when the sink backs up, when something's not working properly, the landlord has to come in and repair that. Here, it's their home.
So you're just responsible for the common areas, utility lines to the property, and then everything within the property, it's their responsibility.
That's right. So it's lower capital intensive than multifamily.
Agreed 100%. During the high inflation, if you compare multifamily to manufactured housing, multifamily takes it on the chin because you have to hire the plumber, you have to hire the electrician, it's the labor, the material.
That's right.
In this case, if they need to repair their home, they need the new plumber, new pipes, new electric within the home, it's them, right?
It's on them. That's right.
What about supply side?
Well, that's interesting because there is no new supply. And I'll explain. So in this industry, unlike any other commercial real estate asset class, you have no new supply coming to market. And the reason for that is NIMBY. So NIMBY is not in my backyard. So
that's a funny term.
Yeah. So no municipality in America wants to see a mobile home park being built. Because residents will complain because of that negative stigma, which in my mind is incorrect. You know, back to, oh, it's drug addicts, back to you're going to bring in riffraff, and I don't want that in my community. No city council, no planning commission who has, has residents within that community as their boss who are going to complain are going to approve those type of projects for political risk. They want to stay in office. Right. So, and the other thing is it's cost prohibitive. So to build this with the infrastructure and to fill those vacant sites, you're looking at a 5, 6, 7-year project. That's just too long for developers. So you have really no new supply, but again, the demand is off the charts. So for those that own existing product, you have tremendous pricing power and the ability to grow your occupancy.
That's a great explanation. I thought it was communities don't have enough tax basis per the services that they provide, probably part of the equation too.
Probably part of it.
But it's also political that the neighbors who own their homes, they don't want manufactured housing community nearby.
No. The people in city council that approve those projects are not going to be very popular. In fact, we're doing so well in a lot of our communities. Like we have a community in Grand Junction, Colorado. We're full. It's actually older product. We have waiting lists of people that want to get in there. We have 15 acres behind us, and we're just now getting approval. We've been working on it for 5 years to expand another 65 sites. And it's just been pulling teeth because the local municipalities get so much pushback, and they're scared that they're going to lose their seat in office if they approve these projects. But everybody knows they need affordable housing. If you go into every city in America, I don't think you're going to go into one that says, oh yeah, we don't need affordable housing here. All of them need it.
We have an affordability crisis. The bottom line,
Absolutely.
all the politicians actually talk about building affordable housing. And I know when they do things in New York, they force developers create certain portion of the property to be affordable. But that affordable is actually extremely unaffordable. Any new construction, the cost is insanely higher versus if you brought in another home to an existing pad.
Yep.
So just give the audience a little size of your operation. I'm just curious, how many parks communities they actually own and operate?
Yeah, so we have manufactured housing communities and storage. Within our overall portfolio across all of our funds, we actually have more storage. We have about 20,000 self-storage units. We have about 8,500 manufactured housing units throughout the U.S., and that's comprised of about 50 parks.
What do you like more? The one thing that I worry about storage, and just a quick comment on this, storage gets approved. People sometimes oversupply markets because they'll go build a nice air-conditioned Class A facility, and
that dynamic
you can't grow demand. You cannot.
Yeah, that dynamic is not working in your favor the same way as MH. So when you ask which one do I like better, right now, all we're buying is manufactured housing.
Because you are supply side protected and you can continue to grow rents predictably and steadily over time.
I think it's one of the hardest asset classes to get hurt on. I mean, you've got to do something really wrong to lose money right now. Really wrong.
Yeah, and that's the conclusion I've come to just observing what has happened to multifamily, how it got overbuilt, oversupplied, including storage in some markets. Storage is very local. The oversupply has damaged some of these projects.
Yep.
But
you may have underwritten the deal perfectly, and all your numbers, you're a mathematician, your model makes sense, but you didn't know 12 months after you buy the asset that they're going to construct 2,000, 3,000 units right in your backyard, and now what?
It's a problem.
Everything's
it's
thrown
oversupplied,
off.
Yeah. And it takes many years to
absorb that.
Yeah. Matt, I appreciate your wisdom. It's so wonderful to visit your office. Appreciate the kind invitation. There's only one problem here. It's like 105 degrees in Vegas. It's I was just in Southern California, perfect weather.
Yeah.
You were in Southern California, so at least the weather.
Well, we stay inside. So being back east like you are, this is like our winter. You got to kind of stay inside and stay shielded from the sun, but the rest of the year is beautiful. Vegas kind of gets a bad rap. Everybody thinks it is hot in the summer, I will admit, but the other 9 months, it's beautiful. So I hope you enjoy your time here. I really appreciate you coming out to the office, and don't be a stranger when you're back in town.
Thank you, Matt.
Thanks, Mike. Appreciate it.